There are many counterintuitive things when it comes to retirement planning. It's one of the aspects of retirement planning that I absolutely love. Now, rules of thumb are great, but there are also many exceptions to the rule. These things are so counterintuitive that they're things you may not even realize unless you've created a detailed retirement plan and worked through multiple different options. In this video, I want to share with you a counterintuitive example if you have a mortgage that extends into retirement. Ideally, the goal is to have a paid off home as you enter into retirement. Having a paid off home as you enter into retirement is an enormous advantage when it comes to retirement planning. Not only will your home continue to grow in value over time, it also acts as a hedge against inflation. Not only that, but when you have a paid off home in retirement, your investment withdrawals are lower. You don't have to make withdrawals to support rent payments. So your investment withdrawals are lower if you have a paid off home. And if you need long-term care or additional costs later in retirement, you have a huge fallback asset that you can use to fund some of those end-of-life care costs. Recently, I saw a stat that said that 30% of Canadians will have a mortgage that extends into retirement. That's 3 in 10 Canadians that will still have a mortgage as they enter their early retirement period. Now, the question is, if you have a mortgage that extends into retirement, should you still be aggressively trying to pay off that mortgage? The answer in some cases, counterintuitively, is no. You shouldn't be trying to pay off that mortgage aggressively. If anything, you might even want to extend that mortgage as long as you possibly can. So if you're in a certain situation, if you've got a mortgage that extends into retirement, counterintuitively, you actually might not be wanting to pay off that mortgage aggressively anymore. In this video, I want to show you an example of how that works. I want to give you an idea if this applies to your situation, and I want to share some of the reasons why this sort of counterintuitive example actually makes a lot of sense. I've come across this situation a few times, and there are a couple things that are always in common. So I want to share those things first, and then we're going to take a look at an example together. So the first thing here is that often there is a sizable mortgage remaining. So not just $50,000 or $100,000 of mortgage remaining, but typically $300,000, $400,000, $500,000, $600,000 of mortgage remaining as they enter into retirement. So typically there's a large mortgage that will have payments that extend fairly far into retirement, usually 5, 10, 15 plus years. So large mortgage remaining is usually one of those factors. Now, the second factor is that typically there's a lot of home equity. So these aren't people who are underwater on their mortgage. They typically have a home that's $1 million, $1.5 million, maybe $2 million. They've got a lot of home equity. They just still have a sizable mortgage of $300,000, $400,000, $500,000, $600,000 on that sizable home. So lots of home equity that they could tap into in the future. It's just that there's still a sizable mortgage left on the property. Now, the other factor is that usually there's a lot of registered assets. So usually there's a sizable amount of assets in registered accounts like RSPs, locked-in retirement accounts, or defined contribution pension plans. There is a lot of registered assets that we can use in retirement. And they're also usually high income earners. So they're usually maximizing those registered assets because they're in a higher income situation. So they're paying off the mortgage, they're maximizing their RSPs every year, but often there's not a lot of TFSA or non-registered assets. So big registered assets maximizing the RSP every year, higher income earners, but there's usually not a lot of TFSA or non-registered assets that could be used to pay off the mortgage. That's the typical situation where we see this come up. Okay, let's walk through this example here together. We're going to use some actual financial planning software to go through this and test some alternative options. Now, in this case, we've got Jennifer and Michael. They're going to be retiring early at age 55 and 54. We can see here that they've got a sizable mortgage of about $450,000 left. They do have a lot of registered assets, so $1.7 million in registered assets and quite a bit of home equity. Their home's worth about $1.6, $1.7 million. It's just they still have a $400,000, $500,000 mortgage left on the property. So still lots of home equity, but they still have a sizable mortgage remaining. Their spending in retirement's quite modest. They want to spend $80,000 a year, not including mortgage payments. The problem is that we've got mortgage payments of over $50,000 a year on that sizable mortgage. They've been trying to aggressively pay off the mortgage, but as we can see, the mortgage is going to extend up to about age 64, 65 here, depending on the payments. So they've got in retirement, they've got withdrawals of $130,000 a year. And that's after tax. So pre-tax, these withdrawals are actually quite a bit higher. So we've got $80,000 for spending, but then a whole bunch of money to support those after-tax mortgage payments. So if I flip over here to income, we can see that their registered withdrawals are quite sizable. They've got a pension here, but in total, they need $160,000 of pre-tax withdrawals to both support their retirement spending and those mortgage payments. And that's one of the big problems with a mortgage in retirement, especially with a lot of registered assets, is that you're making withdrawals to support an after-tax mortgage payment. You're making withdrawals pre-tax from a registered account, sometimes in a 30+% tax bracket. This means that those withdrawals need to be significantly higher than just the mortgage payments. So in this case, we can see they've got sizable registered withdrawals until the mortgage is gone, and then all of a sudden their income and withdrawals drop substantially because then they're just supporting their retirement spending. So lots of tax in early retirement, lots of withdrawals, and then later in retirement, very little withdrawals, very little tax once that mortgage is paid off. So the problem is they end up drawing down on their net worth quite significantly, drawing down on those registered assets. And so their sequence of returns risk in retirement is quite high, especially in early retirement until 64, 65 when that mortgage is gone. You can see how fast those really poor scenarios, how fast they go down towards zero because they're having to make those mortgage payments. So very high sequence of returns risk here in early retirement. Again, if we go to their income, they're withdrawing $130,000 from those registered assets. They've only got about $1.6, $1.7 million. So we're talking about a 6, 7, 8% plus withdrawal rate in early retirement, quite significant. So lots of sequence of returns risk, lots of chance of running out of money because of that mortgage. So let's take a look at what they can do. Let's go down here to the table. We're going to scroll to the right, and we're going to change the mortgage payments here. Now, if you've got a retirement plan and you want to test this out for yourself, if you've got a mortgage in retirement, even if you don't have a mortgage in retirement, you can use the Advice platform to create your own retirement plan. Just go to advice.ca. You can use the software, you can use the AI strategies. We also have webinars that we do twice a month where we go through case studies, retirement planning case studies and examples, and we have a community forum for support. It's just $9 a month to access everything, or $49 for the year. Now let's go down through this example here. We're going to change these mortgage payments. We're going to cut them in half. We're going to extend this mortgage as long as we possibly can. So instead of $52,000 a year, let's just drop this down to $26,000 a year. We're just going to extend this to the end of the plan. The platform's going to figure out when that mortgage gets paid off, so we don't have to worry about when exactly it gets paid off. But let's take a look at the results here. So we've got, at the moment, $2.6 million in estate value, 64% success rate. Let's extend those mortgage payments as far as we possibly can, and let's see what this result looks like now. Now we've actually extended where the risk of running out of money is. We've got a higher estate value, and our success rate is higher as well. So we're spreading out the risk of those withdrawals, and we don't put as much sequence of returns risk in those first 10 years, 15 years of retirement. Now, if we look at income, we have a much better income profile. We're spreading out those mortgage payments, spreading out the tax as well, and we're spreading out all of the risk in early retirement. So overall net worth, they end up in a better position. Overall risk in early retirement, sequence of return risk, they end up in a better position, and they've got lots of flexibility. They've extended that mortgage as far as they possibly can. And importantly, they've done that before they retired, so they can qualify for a re-amortized mortgage. They've done that before they've retired when they still have higher income. and they can requalify. So in this situation, extending those mortgage payments as far as they possibly can ends up in a much better situation for Jennifer and Michael because they've got a sizable mortgage with a lot of registered assets that they need to draw from to service that mortgage. As you can see, this is a bit counterintuitive. Normally, we'd want to have that mortgage paid off before retirement. So logically, you'd think paying it off as quick as possible in early retirement would be the goal. But as we saw from that example, extending those mortgage payments as far as we can actually worked out a little bit better. So why is that? Well, let's go through some of the reasons why that worked out to be so much better. One of them is sequence of returns risk. One of the big risks with having a mortgage in early retirement is that you are having to make investment withdrawals. You don't have the employment income to service the mortgage, so now you're making investment withdrawals to service that mortgage in early retirement. This increases the sequence of returns risk. It increases the risk of a poor period of investment returns in early retirement, depleting your investment assets. You're being forced to make these mortgage payments even when investment returns are poor or maybe inflation rates are high. So sequence of returns risk is a big factor when you have a mortgage that extends into early retirement. The other factor that makes extending that mortgage as long as possible very attractive is that you have a lot of flexibility. So if you can lower those mortgage payments to the lowest possible amount, extend the amortization as far as you possibly can, you just have a lot more flexibility. You can always make additional lump sum payments if investment returns are good, but if investment returns are poor in early retirement, you have that flexibility by having the lowest possible monthly payment that you can qualify for. So extending that amortization, extending the mortgage, if you have a mortgage that goes into retirement, it can give you the maximum flexibility. Now, the other factor is if you have registered assets, making those investment withdrawals to support the mortgage means that you're making very large pre-tax withdrawals from those registered assets. So if you've got TFSA or non-registered assets, this may not be as big of a concern, but if you've got a sizable amount of registered assets, very little other types of assets, then this is a big factor within your decision of extending that mortgage as long as possible, spreading out those registered withdrawals, spreading out the tax burden and the sequence of returns risk. Now, the other factor that's always important to keep in mind is that if you have a downsize in the future, if you've got a sizable home, one of the factors could be that you're going to downsize in the future anyway. And if that's the case, we really shouldn't be in a rush to pay off the mortgage in early retirement if we're going to see some of that equity come back in terms of investment assets anyway. So we don't want to pay off the mortgage early. We don't want to trigger sequence of returns risk in early retirement only to have a whole bunch of that equity come back to us in the form of a downsize. So if a downsize is in the future for your retirement plan and you've got a sizable mortgage entering into retirement, just extend those payments as far as you can. Give yourself the maximum flexibility, but don't necessarily be in a rush to pay that off in the first 5 to 10 years of retirement. Now, this type of planning can be quite counterintuitive. It's not what you would normally expect in a retirement plan. It's a bit counterintuitive from the typical rules of thumbs and financial advice that you'd see online. So you need to have a detailed retirement plan for your specific situation. Test to see if this makes sense if you have a mortgage that extends into retirement. Test to see if this makes sense for your situation. Every situation is different when it comes to retirement plans, so you want to make sure that this works for your situation specifically. But as we saw, it can be an advantage for a number of different reasons. It can be quite an advantage to extend that amortization, extend those mortgage payments if you have a sizable mortgage that extends into early retirement. Thank you so much for watching. I'd love it if you like and subscribe, and we'll see you at the next one.